You ready? Good morning and welcome to the Central Bank of Kenya Monetary Policy Committee press conference. Today is the 27th of November 2020. The Monetary Policy Committee of the Central Bank of Kenya held its meeting yesterday on November 26th. The press release was sent out and we hope that you've all managed to receive it and interact with it. And so, as we traditionally do on the day after the MPC, we have a press conference that will be hosted by the Governor of the Central Bank of Kenya, who's also the chairman of the MPC, Dr. Patrick Jorge. He will go through his statement and his remarks. After that, we shall be welcoming questions and answers from you, the members of the media, analysts, and all the rest. As we have told you on all platforms, you can send in your questions via Slido. That's www.slido.com. The meeting ID is #MPC11. When you send your questions, please make sure you identify yourself by name and institutions, and then we shall then take those questions at the appropriate time. But without further ado, I'd like to welcome the Governor of the Central Bank of Kenya and Chairman of the MPC, Dr. Patrick Jorge.
Thank you very much, and good morning to all of you. So as you expect, we will go through some of the points that came up in the discussion yesterday at the MPC. And as you are aware, we issued a press communique, press release that covered not only the decision, but also some background as to the decision and indeed to the discussion. So we'll cover it, but today I want to change tack a little. And we'll begin with global developments, as we always do, and then talk about external sector, and then move on to the domestic sector. So in terms of the global developments, these are observed to be better than expected in terms of the recovery in Q3 of 2020. And this followed, of course, the very steep declines in the second quarter. And obviously, this followed the enactment of the various containment measures to protect the population from the COVID-19 pandemic. But nevertheless, the recovery, even in Q3, is incomplete and uneven. A second wave of infections have dampened the global recovery momentum, and with new containment measures and prospects for more in the advanced economies. So this has elevated the downside risks of the recovery, making it even more uncertain. However, as you all know also, there is a lot of excitement around the recent announcements regarding the possible breakthrough in developing of COVID-19 vaccines. The news about the vaccines and, of course, the completion of the US elections have injected a dose of optimism, dose of hope. Could even say light at the end of the tunnel, if you will, or even a rainbow in this rather difficult time. Of course, there's still a lot of work to be done on this in these areas to make those reality. So the policy stance in the advanced economies remains accommodative, with discussions still ongoing around additional fiscal stimulus in the United States and concerns about a codependency of the financial markets and additional monetary stimulus, particularly in the context of the US economy. So that's what I wanted to say in terms of the background of the global economy. The external sector, the balance of payments, how has this developed? First, exports have rebounded after the decline that we saw in April, May, again following the containment measures that were put in place in the Kenyan setting, and this included, as you recall, even cessation of flights. That's the closing of the skies, termination of flights out of Kenya, passenger flights into and out of Kenya. Merchandise exports in January to October grew by 2.8% relative to a similar period in 2019. I think we could probably put up one of the first slides, but I think most of you are aware of that. And so this is merchandise exports, which obviously grew quite sharply. By the way, this compares to the growth in January-August, meaning for the period January-August relative to January-August of last year. The growth there was 0.8%. And so you can see there's a sort of more dynamism in terms of the growth of merchandise exports. What really underlay this rebound of exports? First is tea exports. And we can go to the next slide. This increased, there was increased production, and minimum disruption in international supply chains, that is with regard to tea. And to end September, production was up 33%, and the volume of tea exports January to October, again, relative to January to October 2019, was up 23%. The value also of exports during those 10 months was also up 13% relative to a similar period in 2019. On horticultures as well, horticulture is also normalized, or in a sense also rebounded well, after normalization of demand in the purchasing countries and adequate cargo space or return of normal travel, and therefore adequate cargo space, including maybe the increase in cargo space through freighters, etc. And in terms of vegetables, for instance, vegetable exports, the volume of that in the period January to October was up 66% relative to a similar period in 2019, and the value was up 17%. I think that is clear. It doesn't quite add it all. This is what is shown on the screen is the quarterly numbers, but in terms of the 10-month period, it is 17%. Now we go to flowers. Next slide, please. Flowers have been an interesting dynamics, as it were. You can see towards the end, meaning the period July through October, the exports of flowers, they've actually been generally larger than the same period last year. And we reported on the growth rate July, October relative to July, October 2019. The point is that actually the recovery has taken place since May, but June was a month that was quite distorting. It distorts the numbers in a sense, if you excuse the term, because actually in June of 2019, there was unusually large exports because of some constraints, production constraints that were seen in a competing sort of producing country. And therefore, Kenya was able to expand its exports more than, beyond even the normal limits, as it were, production limits, etc. So that's why that number is so out of line, as it were, relative to where it ended up in 2020. But bottom line here is that you can see the flour exports have actually rebounded, recovered quite well. Now on fruits and nuts, the volume of fruits and nuts exports, that also has increased by 45%, and the value has also increased by 3.7%. Bottom line is these were the drivers, or the principal drivers of export, the rebound in exports, more generally speaking. But there has been also good progress in other products, etc. On imports, these have declined, and January to October, these were down about 13% relative to 2019, reflecting mainly lower oil imports with the lower international prices. Currently, the price of Marbon oil, which is our sort of benchmark oil, is at $44.2 per barrel, which is a far cry from where it was, say, a year ago, etc. But nevertheless, chemical imports have increased by 3%, while manufactured goods have fallen by 9%. Machinery and transport goods have also fallen by 16%. So on the whole, even as oil dominates, the other indicators, the other, let's say, imports, broadly speaking, have also declined. Chemicals, as we have said, it's actually positive that it has increased, because this really contributes to intermediate, these are part of the intermediate goods, which will be used for various processes going forward, manufacturing, etc. Remittances, next slide, please. Remittances have remained robust, as you can see. And in October, there were, the total number, we received $263 million in inward remittances. And for the period January to October, the remittances have grown by 9%. This is something, obviously, that we don't take for granted. And next slide will show it. Yes, this is a very busy slide. But I think it's worth looking at it a bit more carefully. Unfortunately, it was, it is a picture, so it couldn't be improved. But basically, it groups countries, or it is a listing of countries, and it shows the level of remittances in the second quarter of this year, and also the third quarter of this year. And the black bars are all quarter two. And you can see many of them, except the countries towards the right, many of them are actually declines. So this is the year-on-year change, in remittances. And you can see a lot of them were negative. However, the quarter three, the greens, a lot of them are still negative, but you can see that there are some positives. And Kenya is the one that is circled. You can see that, in a sense, it bends the trend. So you have Kenya, you have Bangladesh, you have, I guess, Dominican Republic, Pakistan, you have El Salvador, and a few others. But I think in terms of showing that, why remittances are important to us, or let's say the differentiation of our country, Kenya, versus other countries that are also dependent on remittances, we have done quite well, as this chart demonstrates. What's the bottom line? Next chart, please. The bottom line is that the current account deficit, for the 12 months to October, is estimated at 4.9% of GDP. And this compares to 5.3% of GDP in the year to October 2019. We project the current account as shown on this chart, the current account deficit to be at about 5.1% in 2020, and then 5.2% in 2021. And that is obviously around where we expect it to be in the medium term. We've made the point that from our perspective, in the medium term or in the long term, we expect the current account to be around 5% of GDP. So that's more or less where we are, and that looks appropriate. Now, having said that, I think it is also important to say that we have reserves of the order of $7.95 billion US dollars, the equivalent of that, which is about 4.89 months of import cover. And we expect, therefore, given the dynamics in the current account, and we expect, therefore, the foreign exchange market to remain in relative balance. And this obviously should be reflected in the FX market in terms of the exchange rate, etc., which obviously is inconsistent with the screaming headlines that at times seem to grab your readers and indeed grab the journalists. The chart we have of the developments of the exchange rate, could you please show it? A chart, please. Yes. So this is the developments of the exchange rate in the year through November 26, so just yesterday. And you can see that the Kenyan shilling has, this is all relative to the US dollar. And you can see that it has depreciated against the US dollar by about 8.4%. And you have all other countries around there. So more or less in the middle. Now, we had shown you last time the historical numbers. I'm not going to show you that. But I want to show you something else, which is the period March through through yesterday. So this is the period, let's say, post the COVID crisis. So from March 1 all the way to yesterday. So you can see again, Kenya is more or less in the middle, around 4.5% of depreciating against the US dollar. And I think it is, it's worth appreciating what is behind this, meaning we are true to our policy on the exchange rate, that we have a flexible exchange rate regime, and we don't have a direction in mind or a level in mind. We allow that to be determined in the market. The only thing we do is to minimize volatility, because volatility has significant financial stability risks. So we minimize that, but the rest of it, you can see, has not been, let's say, excessive, or whatever other words have been used by some of the, let's say, analysts or, reporters. Let's now move to the domestic economy. And I think the first thing I want to say is that we have had some very good surveys following from what we did 2 months ago of the hotel industry and also flower farms. And this is because those sectors were problematic in terms of the concerns that were coming up, also from yourselves, but I think also from a perspective in terms of the MPC. Questions were asked, and we needed answers for them. So the first one is on the hotels in operation, which you can see. This is from the survey of hotels that we did. And I just wanted to say that it's, you can see that the hotels are now back in operation. It doesn't mean that hotels are 100% operating, meaning they have all restaurants open, or for that matter, they have all the, residential wing, as it were, in terms of the rooms availability, et cetera, et cetera. That may be at different points. But I think in terms of operating, I think these numbers are much more, well, they are good numbers. They give comfort that the economy is actually turning the corner, or the hotel sector is turning the corner in terms of the impact of the COVID-19 pandemic. So that is on the hotels side. But I would also say that some of the hotels that were not fully operational, they did say that, some of them were actually renovating. So they used the occasion to renovate. And others had specific restaurants sort of operating, but not all of them were operating, as I explained a moment ago. Bed occupancy remains low, but this has recovered. So I'm not sure if the next slide has it, but in Nairobi, they are in the order of 16 to 17% bed occupancy. And in the rest of the country, they are somewhere around the 30% range. There's some ways to go here, but I think the direction is obviously favorable. From the flower farms also, all of them are now operational, 100%. Next slide, please. And they are operating in the order of, they're operating at around 88% of the pre-COVID levels. Next slide, please. Oh, okay, fine. So there's a slide missing in here. So yes, so flower farms, and the average orders for the next 4 months is over 80% for these flower farms that we surveyed, 80% of the pre-COVID levels. So that is quite favorable. Of course, we had the standard MPC market perception survey, but in the interest of time, I will not cover it. Just to say that all 3 surveys will be put out on our website, so you can go in there and see what, what you can tease out from the data that is, the rich data, I should say, that is from these surveys. So now we move a bit to the bottom line, as it were. And here is where there has been a lot of discussion in the media and elsewhere, in various platforms, discussions about the economic prospects and indeed the performance in 2020. And so what we have done is we used all available data. That is, obviously we know KNBS, which is the Kenya National Bureau of Statistics. They have released Q1 and Q2 data, their own estimates. We've looked also at, say, other sources, KRA, that's the Kenya Revenue Authority, both in terms of revenues and also in terms of other, underlying data, and then also leading indicators. So we've looked at the leading indicators for each one of the various sectors. And the sort of sum total of all that work is presented on the slide, which I think is probably the first time you are seeing such a comprehensive sort of positioning of sectors, growth rates, etc. On the left-hand side, the first three columns, that is data from KNBS. So those are data that I'm sure you have interacted with quite closely. And you can see, for instance, bottom line of the data at the bottom. 2019, the growth rate, the real growth rate of 5.4. And then in Q1 of 2020, growth rate of 5.2. And Q2, a growth rate of minus 5.7. Those are the numbers that you are well acquainted with. The point, though, is I need to stress that the quarterly numbers are year on year. So it is quarter one of, let's say, 2020 relative to quarter one of 2019, and the same with quarter two, etc. So what we did is the next two columns is Q1 and Q2, the ones that have the asterisks on them. These are looking at the numbers that KNBS has put together, and we ourselves using the additional information that I've given you. So for instance, agricultural sector. The agriculture sector in Q1 was showing a production, a sort of a growth rate of 5.8, right? And sorry. Could you go to the next slide, please? Okay. So this is what we have here. So in agriculture, the initial forecast, which are the ones that were used, that KNBS used, are shown in the column that says initial 2020 forecast estimates. These numbers actually come from the Ministry of Agriculture. And you can see, for instance, maize production. The expectation was 36.9 million bags of maize. That is the expectation for the harvest. And these were the numbers that were used for Q1 and Q2 growth rate estimates. So what happened is we have now looked again, talked to Ministry of Agriculture, and also looked at what is happening in the various crop growing areas. And we have come up with Ministry of Agriculture and others with the column, the forecasts that are shown in the September 2020 forecast production, right? I'm sorry, in the November, it's the November one that I should be talking about. So you can see that the forecast now is of maize production of 44.9%. and 44.9 million bags of maize. And the same applies to all the other products, the main products as shown there. Again, this is using the information that has been provided to us, and again, validated in some sense, but has been provided to us by the Minister of Agriculture. And therefore, we expect KNBS will be using those numbers, in their revisions of Q1, Q2, Q3, and Q4 data when they finalize the numbers for the year. So you can see, for instance, that the projection for maize relative to 2019, there's a 12% increase in the volume of maize, and so forth. You have all the other numbers. But we've done this not just for maize production or crop production, but also other things like milk, etc. So that is how, going back to the old slide, please. That's how we've come up with the new, that is the November CBK estimates of 5.8 in Q1, 6.2 in Q2, 6.8 and 5.6 in Q3 and Q4 respectively, totaling, doing it correctly, 6.2% for the year. So that's really how it is. And you can see on the last two columns the differences between, that is for Q1 and Q2, between ourselves and KNBS. And I want to mention then a few. Obviously, you can see in Q1, there is a large difference with agriculture of 0.9%. In terms of 0.9%, they had 5.8, and we have, they had 4.9, and we have 5.8. The other numbers that are worth looking at are accommodation and restaurant. And I think the point is this in Q2 That is why you can see significant differences, 18.9%. We have minus 54 and they have minus 83. The question is, how much did the hotel sector really contract during that second quarter? And I think the point we are making here is that we've looked a little more in detail in terms of the information that has been given to us, including in the surveys. And I think obviously this is information that we will be providing to KNBS. There are two other things I would want to mention. I think in the interest of time, I'll just leave this and we could have conversations about it later. But no, go back to it, please. Yes, so there are two areas that I think we need to look at a little more carefully. And this is manufacturing and ICT. And there we have a lot of data, as I have mentioned. And in manufacturing, actually, the sector has been doing better than was expected. And it isn't just ourselves that have made that point. Much more recently, even the PMIs that are done generally by Stanbic Bank, these have actually have shown significant improvement in the manufacturing sector. Now, we've not only looked at those numbers, we've looked also at electricity consumption, we've looked at KRA numbers, et cetera, and therefore we think we have a better estimate that is the one that we reflect in the columns that we indicate as November CBK estimate. Bottom line, our growth rate of 2.9% for 2020. I would mention that a significant driver of this is education. The education sector, as you know, was completely, students who are not in their usual learning stations, meaning they are not in school. And a lot of students, they are now students that have gone back to school, as we know. But for the most part, earlier in the year, particularly Q1, Q2, and Q3, the students were largely at home, with online for those that could do that, etc. But at the same time, teachers were paid by the public sector in full. But the question then is, how do you estimate the production, in the education sector? Now, KNBS has changed the way they do things. They've been using numbers of students, etc., in the past, but now in the context of COVID-19 and the students being at home, they've used a different methodology. Bottom line is the numbers that are shown there. In Q2, you can see a significant dip of 56%, etc. And the point for us is, if you, in a sense, ignore the pressures from the education sector, you would actually end up having a growth rate of 2.9%, 3% basically, which is the last row in the table that we're showing there. Bottom line is, again, as I said, growth rate. We expect the growth rate, including the KNBS's methodology, new methodology. We would expect that to be 1.3%. I'm sorry, I may have misquoted, may have said something else, at 1.3% for 2020. And this, in a sense, reflects our best understanding of all the numbers that the economy is generating. There's a question that will probably be on your mind that recently our Cabinet Secretary of Treasury talked about a number in the order of 0.6% in 2020. As a matter of fact, that number is fully consistent with our 1.3. The difference is if we are using our best estimate for Q1, Q2, Q3, and Q4. But if you used KNBS's numbers for Q1 and Q2, which again, as I say, will need to be revised to reflect the new information, including in agriculture, et cetera, et cetera. So if you use that, that is, if you use, for instance, in the growth rate of minus 5.7 in Q2 and 5.2 in Q1, then you'd have a number in the order of 0.6, which is the number that the CS quoted. So these numbers really are consistent, and I think it is important to appreciate that. That's all I want to say, underscoring the cautious estimate of 1.3% of GDP growth in 2020. That is our expectation. Let's move on. The banking sector, just to say a few things there, it remains stable, it remains resilient, adequate liquidity, and well distributed in the sector, both in terms of, well distributed. Of course, credit risk remains elevated, and NPLs have remained at, this is the NPL ratio, has remained at 13.6% in August and August through October. So that has been stable there. Of course, there has been a restructuring of loans. Banks have been have worked hard in terms of restructuring existing loans, as we had explained before. And this is all in the post-COVID period. Loans that were performing at the beginning of March. And the total number of loans, or total value of loans, is 1.38 trillion that have been restructured. 46.5% of the total loan book, the sector's total loan book of 2.9 trillion. The question, as we explained last time, is the question that is important is why. And we explained this last time. In a sense, the idea here was for banks to protect their balance sheet. So in the short term, due to COVID, their borrowers will generally have less to pay. So they'll come under liquidity pressures in that sense. And the idea here was having that sort of restructuring discussion with the borrowers, and then come up with a solution that actually is appropriate for the borrower and also for the lender, in this case, the banks. And I think that has worked quite well. Banks appreciating the need to protect their balance sheet as opposed to protecting their P&L. So yes, on the P&L, this is the profit and loss, sort of financials, if you want to call them that. There, of course, there'll be much more, let's say, there'll be more, the numbers will be worse because there'll be less profits, and this is what has transpired. I want to just mention that profitability of banks, we are now looking at the September numbers. As we explained, we generally look at each quarter we look at all the accounts that banks provide to us. And yes, there has been a reduction in the profitability of banks. As I explained, that was in a sense predicted. That was what was expected. But at the same time, you have also had a reduction in the return on return on assets, and indeed on return on equity. In terms of sectors generally, the return on equity has come down to around 15.1%. And this was in the order of 22.5% back in September of 2019, a year ago. But again, the issue here was to protect the sector from the perspective of the balance sheet, and the sector also has been moving, as we had explained, to a new normal. as I'll mention also in a minute. Return on assets and return on equity at September 2020 stood respectively at 1.8% and 15.8%, which is down from 2.7% and 22.5% in September, as I mentioned. So that's on the adjustment. But the banking sector has not been idle. They've not just waited for the COVID cloud to lift. They have been acting in the context of the new normal and strengthening their business models. And one of the things that we have seen and that you have seen is a lot of action even during this period with regard to mergers, acquisition, etc. And I think there are several of these. In 2020, we have had the acquisition of Transnational Bank by Access Bank of Nigeria. We've had acquisition of Mayfair Bank by CIB Bank of Egypt. We've had the acquisition of Jamii Bora Bank by Cooperative Bank of Kenya, and also an external acquisition of Bank Commercial du Congo by Equity Group Holding, by our own equity. Now, there was also an announcement yesterday about KCB also seeking to acquire, obviously subject to regulatory approvals, a bank in Rwanda and also another bank in Tanzania. So you can see our banks have continued to move despite the difficulties that we are seeing in the economy. The banks are moving towards the new normal. Incidentally, in terms of mobile numbers, the use of digital platforms. So from March to October, there has been a growth in the value of low value transactions. Significant growth, something in the order of 15%, I believe, in the low value transactions. And we are talking low value, less than 100 shillings. So this has been significant. Additionally, some 2.7 million new or previously dormant accounts, this is money wallets basically, have been brought on stream. And this has increased the numbers in terms of wallets or active wallets by 10%, all in this period of March to October. And then P2P transactions, these are person-to-person transactions, the volume has increased by 87% during this period, and the values have increased by 55%. So digitalization is what is it? This is what is going on, digitalization. And I think this is extremely important for us as we go forward, and in some sense, a significant help, which has in mitigating or in having those remedial measures against COVID-19. I want to say a few things before I finish, a couple of things. The first, obviously, is that we had a conversation about fiscal performance and implementation of the economic recovery program, which was announced in the budget, and this is ongoing. And so that was important to understand where that is. But obviously, one of the things that is clear is that the fiscal budget, there are some revenue shortfalls that have emerged. To October, the cumulative revenue shortfall is 65.4 billion, cumulative. And ordinary revenues cumulative shortfall is 57.7 billion. Mind you, I want to stress the number is 65.4, not anything else. Now, As was mentioned in the press communique or the press release, we do understand, and this has been announced, that the government will be revisiting this positioning in terms of what needs to be done in the context of the pressures that have emerged in terms of the revenue shortfalls, and indeed also expenditure pressures that have also emerged. So the government expectedly may put forward some revisions in budgets or revisions in numbers, of course, or revisions in policy. Those are things that obviously we have been broached and by the CS and others. But I think the point here is that it's something that is important for us, particularly to anchor the budget in a long-term sense, also to anchor other elements that connect with the budget. Finally, you also know that we have been in discussions with the International Monetary Fund, the IMF, that would lead to an economic program or financial support by them. The overall package and policies and numbers, those have not been completed. So we are in this period of ongoing discussions, and we expect that that will be completed. Obviously, there's no point in waiting for things. There's nothing to wait for. So we complete it, but according to our need and according to our sort of assessment of what is good for us. Finally, there was a conversation that had also been started in the context of the IMF program, and this was in the Debt Service Suspension Initiative, which is an initiative of the G20, and now the CS was very clear about where we stand as a country on the DSSI. The point, though, is that we need to look at it in the context of what is good for our country, and to look at the various risks that and benefits and weigh them as we go into this. But clearly, the CS in the previous debt document, I guess that was at the beginning of this year, did talk about having to look at the various options, all options on the table in terms of dealing with our debt and bringing it on a sort of a path that would lower it. It is currently sustainable that we've made that point before, but the point here is that we need to move away from the dangerous sort of margins, closer to the edge of the table and more to the middle of the where we should be. So those are the points I wanted to raise with you, and now I'm open to your questions. Thank you very much.
Thank you very much. That was the Governor of the Central Bank of Kenya, Dr. Patrick Jorge, who also is the chairman of the Monetary Policy Committee. Now, for the first time since I started doing this quite a few years ago, there are no questions whatsoever. So just checking from the last minute. Oh, there's one that's just literally come in 5 seconds ago. This is from Franklin Sunday. He's simply asking, will the Central Bank of Kenya extend the waivers on mobile transactions below 1,000 shillings beyond December 31st, 2020? That is the only question that we have. So Governor, you can take that one.
Thank you very much. We are thinking about all the options. At this moment, we cannot announce that we will or we will not. I think the best thing is to be a bit more patient, and we'll say something in due course.
Thank you very much. Franklin, you got in literally at the very last second, like someone who runs marathons for a living. So thank you very much for that one. And since we don't see any other question, we thank you very much for joining us this morning for the post-MPC press conference. This, as we said yesterday during the MPC, or rather in the MPC communique, is the last MPC meeting for the year, but as it usually says, if there's any need for the Monetary Policy Committee to meet at any point, then they will call for a meeting and we'll let you know in good course. But for now, thank you very much for being with us. If we don't see each other again, do have yourselves a Merry Christmas, lovely holidays, and a Happy New Year, and we'll meet again when we come back to speak to you. Thank you, and have a good afternoon.